Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
Beyond Meat, the name that once, defined disruption and high growth, is now, well, it's describing a company trading at seriously distressed levels. We just saw it hit 88 cents a share, with these massive high-volume swings that tell you the market is grappling with a genuine existential risk. The firm's market cap is hovering right around $400 million. The whole collapse has been, it's been catastrophic, and it all really came to a head with the essential, but let's be honest, brutal financial surgery of October 2025.
And that surgery, right, while it might have stabilized the patient on the table, it fundamentally changed the prognosis for anyone holding the common stock. We're looking at a restructuring that I think people will be studying for years. It's a massive debt-for-equity transfer that was sort of disguised as a recovery plan.
So that's the central question for us, isn't it? Was the October 2025 distressed exchange a successful strategic move that actually secured the company's future by ensuring it was solvent? Or was it a fatal blow that structurally destroyed the common equity through just massive hyperdilution and a quiet loss of control? I'm going to argue that the restructuring was necessary, it was strategic, and most importantly, it preserved the one thing that matters most here, the entity's option value and the time they needed for an operational miracle.
See, I come at it from a completely different angle. I think that restructuring created these insurmountable structural roadblocks, mainly a permanent, massive supply overhang of stock that just condemns the common shares to ruin. Beyond Meat is, for all intents and purposes, a financial zombie now. It's been engineered to survive just long enough for its new masters, the former creditors, to squeeze out whatever value is left.
Okay, well, let's start with the existential threat they managed to avoid. Beyond Meat was staring right off a cliff. They were facing over $1.1 billion in these 0% convertible senior notes that were maturing in 2027. And given their cash burn, there was absolutely zero possibility of them meeting that obligation. The 2025 exchange was successful survival engineering. By pushing those debt maturities out to 2030 and converting some of that principal into stock, they pulled the company back from the brink of immediate bankruptcy. This buys them a crucial commodity, time.
Time, purchased at the extreme cost of anyone who held the equity before this deal. That's an interesting way to frame it, but I'd frame it differently. They didn't solve the insolvency. They just kicked the biggest part of the debt wall 5 years down the road. And in the process, they ensure that any future success, however unlikely that is, will be shared across an astronomically larger shareholder base. You mentioned time, so let's actually quantify that. They have a cash runway of, 3 to 4 quarters? Based on about $117 million in cash and a burn rate in Q3 of over $41 million. That is not stability. That's a very short ticking clock for the operators set against a very long and very demanding debt clock.
But that ticking clock is exactly what allows CEO Ethan Brown the time to execute his operational turnaround. Critically, that includes the Beyond IV product update, which is aimed squarely at fighting back against this damaging ultra-processed ingredient narrative. The company, they've preserved its brand IP, its distribution deals, its manufacturing footprint. All of this still holds theoretical option value. And if you want proof that the market sees some kind of residual value, just look at the consensus analyst price target. It's around $1.61. That implies nearly 80% potential upside, even from these levels. It reflects a recognition that the underlying brand is worth preserving.
I'm sorry, I just don't buy that the analyst target is meaningful here. And let me tell you why. That target is a lagging indicator. It fails to really incorporate the scale of the financial destruction that just occurred. This deal was a mechanism to legally transfer economic control to creditors. It fundamentally destroyed the common stock's ability to ever recover, all through hyperdilution. And the evidence for this destruction is, it's concrete. The share count exploded. It went from roughly 76.6 million to a staggering 453.6 million shares outstanding. That's a 491% increase. You cannot possibly expect the stock to regain any significant altitude when you introduce that kind of monumental structural supply overhang. And what's more, the new structure includes these 7% PIK toggle notes due 2030. PIK, payment in kind means the company is so broke it's paying interest by issuing more debt. The principal is just compounding at 9.5%, pushing equity further down the line. Meanwhile, the Altman Z-score, the measure of financial health, is still highly distressed, somewhere between -2.3 and -3. For anyone unfamiliar, a Z-score below 1.8 basically means the model says you're likely to go bankrupt within 2 years. So the entity is structurally impaired, the debt is growing, and the equity is diluted into oblivion.
I acknowledge the pain and, the mathematical implications of that dilution. It's the highest possible cost of survival. But let's move to our core disagreement here. The probability of a price recovery versus the certainty of that supply overhang you're talking about.
Well, the massive dilution ensures that any little tick up in the price is just going to be met with this persistent structural selling pressure. We have to be really clear about who got these 450 million new shares. They went to the former convertible note holders. These are, by and large, distressed hedge funds, institutional investors. Their goal is not to hang on for a 10-year turnaround. Their goal is to monetize their recovery and do it now. They are permanent structural sellers who will cap any rally. And if the bull case for the stock is some kind of retail-driven short squeeze, the technical data it completely annihilates that argument. We have over 123 million shares held short, yes, but the days to cover ratio is only about 2.4 days. This basically measures how long it would take for shorts to buy back all their shares. A 2.4 ratio confirms that the supply is so vast, the liquidity is so high, that short sellers can cover their positions easily. They can just quickly kill any squeeze attempt. The supply overhang is simply insurmountable.
That's a compelling, detailed breakdown of the short interest mechanics. And I'll grant you the float expansion does significantly reduce the chance of a classic short squeeze. But I think you're focusing too much on the selling pressure. Let me give you a different perspective on value and the price floor. We have to assume the dilution is substantially priced in at 88 cents. What we're left with is a company whose enterprise value is still substantial, around $1.6 billion. That valuation suggests there's a tangible asset base under all that debt and diluted equity that has to be accounted for. The value isn't just in the brand IP, though that is significant. It's in the physical assets, the manufacturing capacity, the cold chain logistics, the distribution contracts with major retailers. These are not easy things to replicate. The low stock price, ironically, transforms BYND meat into a high volatility speculative asset, which attracts different kinds of capital. And its inclusion in funds like the Roundhill Meme ETF forces passive buying regardless of fundamentals, creating a kind of technical support that establishes a floor.
But the foundation for that floor is rotten because the operational cash flow can't support the asset base you're citing. And that brings us to governance, which is where the financial structure really starts to infect operational decisions. The governance change that happened in October, it's not a sign of rigor. I believe it's a quiet coup. It signals that control has fundamentally shifted away from the founder's growth mission.
I just see it as necessary rigor. It was demanded by sophisticated creditors who just took a massive haircut on their debt and now own a huge chunk of the company. The separation of powers, where CEO Ethan Brown stays focused on the product while he resigns from the board, it ensures the board is now laser-focused on solvency and capital structure. That is the primary immediate need. It's an effective check and balance system designed to stop a founder who might be a little too focused on growth from risking the company's survival.
Okay, but have you considered who they brought onto that board? The appointment of Alexandra Zinger, a specialist in distressed assets and corporate turnarounds, that signifies a de facto change in control. Zinger's not there to discuss pea protein formulations. His mandate is clear: maximize creditor recovery. And that often involves asset sales, cost-cutting, and managing liquidation scenarios. This is what I call the short leash theory, when the founder's growth mission diverges completely from the board's duty to its new creditor shareholders, debt servicing becomes the only priority. And that divergence often precedes some radical corporate event, like a major asset sale or ultimately a Chapter 11 filing that wipes out common equity completely.
I'm just not convinced that the presence of one distressed asset specialist automatically means liquidation. It implies strict financial discipline, which was clearly missing before this restructuring. the fact remains, the alternative to this new governance structure was almost certainly an immediate default in 2027. They structured a deal that keeps the brand alive and intact, giving management 5 years to execute.
But the structure can't cure the core operational rot. We keep talking about financial engineering, but we haven't spent enough time on the existential demand crisis. I mean, all these financial moves just delay the inevitable. If the consumer continues to reject the product, this is where the short cash runway smashes into that long debt runway.
That is the most painful truth this company faces. And it brings us right back to that short-term clock.
Precisely. We have to look at the Q3 2025 figures. U.S. retail revenue plummeted 18.4% year over year. That is not a small cyclical dip. That is a severe secular consumer rejection. It's driven by that whole ultra-processed ingredient narrative. Consumers are actively leaving, and new customers aren't coming in fast enough.
I fully acknowledge the severity of the demand crisis. An 18.4% decline in your core retail channel it's disastrous. And on top of that, a gross margin of only 10.3% confirms the unit economics are terrible. The company barely covers the direct costs of making the product. They're selling these meat alternatives at razor-thin margins, leaving almost nothing for overhead, R&D, marketing, or, most critically, servicing the debt on those growing pike notes we talked about.
Right, if they're only making a 10% gross margin, they are fundamentally unprofitable before they even pay the corporate bills or service that debt. No amount of financial restructuring can fix a product that consumers are actively abandoning because they think it's unhealthy. The Z-score isn't just warning about debt, it's warning about the inability to generate any earnings to support that massive debt structure.
However, this is precisely why the temporal runway matters. The restructuring bought time until 2030 specifically to address this core consumer problem. I'd argue that, supply chain problems are often easier to fix than demand problems, but Beyond Meat's brand recognition still provides a window to solve the demand issue. And they are using this time. They're trying to reverse the narrative with Beyond IV, focusing on cleaner labels. If they can successfully shift consumer perception, they could potentially reignite growth. I mean, look at a peer like Oatly. Its initial problem was supply chain. They couldn't fill orders. Beyond Meat's issue is demand, a lack of orders. But the brand is still huge. If they can execute a product pivot, holding out until 2030 allows that option value we talked about to become real. It opens the door for a major strategic buyer, a General Mills or a Nestle, to acquire a well-known brand that's cleared its immediate debt hurdle.
That is a huge, highly speculative if. You're betting on a massive, rapid consumer sentiment shift to justify a $1.6 billion enterprise value when U.S. retail is shrinking by nearly a fifth every year. And this turnaround has to happen within 3 or 4 quarters before they run out of cash and have to go back to the capital markets, which will be brutal. The operational decline just confirms the Altman Z-score's warning. They're technically solvent now, sure, but structurally the entity is unstable.
I still stand by the view that the October 2025 event was a successful execution of survival engineering. It pushed a $1.1 billion debt wall 5 years into the future. And while the path ahead is incredibly difficult, the company now has the time and the brand equity to stage an improbable but plausible turnaround. By clearing that near-term risk, they kept the door open for strategic buyers who value that core brand IP.
The common equity is structurally condemned. The cost of survival was the permanent impairment of the common shares from that 491% dilution and the effective loss of founder control to creditors. The massive supply wall, 450 million shares, plus a growing pike debt burden and shrinking revenue, it makes the probability of long-term equity value destruction overwhelmingly high. The note holders won. They exchanged bad debt for stock they intend to sell. The legacy shareholders fundamentally lost their position.
Ultimately, the long-term fate of Beyond Meat really hinges on this critical race against time. The question remains, can management stabilize and reverse that 18.4% decline in consumer demand before the massive supply wall of stock and the growing pike debt pile extinguish any remaining hope for common equity?
It is a structural conflict where the debt structure has already weighted the scales so heavily against the common shareholder. It's turned the remaining equity into a highly volatile lottery ticket rather than a sustainable investment.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.